I would like to welcome everyone listening in to Capital Link's Shipping Sectors webinar series. My name is Jorgen Lian. I am head of shipping equity research at DNB Markets. And today's webinar is going to be on the product tanker sector, discussing sector trends, developments, and outlook. Our discussions will be sector focused. I will be moderating the discussion, and we are privileged to have with us key leaders from the industry who I will introduce shortly. But first, two quick remarks. First, a disclaimer. These webinars are for informational and educational purposes only and do not constitute investment advice or advice of any kind. You can submit your questions during the session using the button at the bottom of the screen, or email them to questions@capitallink.com. These questions will be addressed at the end of the panel discussion. And also the questions should be primarily sector focused. By the way, this webinar will be available as a replay later for those who would like to access it on demand. So with that being said, let me now introduce our panelists. And we have with us today from Hafnia Tankers, we have CEO Mikael Skov. From DMCOF International Shipping, we have Carlos Balestra de Mottola joining us as well. And we have from Scorpio Tankers, we have Robert Bugbee, and finally we have Lois Zabrocky from International Seaways joining us as well. So I'm very happy to be here with leaders of this industry to figure out what's been going on and what to expect going forward. We've had a very strong period within product tankers now for the past couple of years. So I thought I'd start with the current picture and what you experience has changed, or what has been going on in the recent months that has led to rates dropping off a bit, although not unusual, perhaps for this time of year. But is there anything that we should be aware of? And let's start with Mikael on that, and then we'll go through the lines.
Yeah, thank you for this, and thank you for inviting us to have hopefully an interesting debate on how we see the markets going forward. So I guess in a way my initial comments to what you asked would be that we haven't actually seen a massive change in the fundamentals around tonnage supply and demand in general. I think what we are seeing is an element of seasonal volatility, but admittedly a lot more than we would normally see from a third quarter to a fourth quarter. But one of the main reasons why we have seen this drop in rates has clearly been that during the third quarter, we did actually have quite a lot of crude tankers that took away, if you like, clean products transportation. And as far as we can see, most likely crude tankers loading clean products took away as much as 6% in ton mile. And what we're seeing now is that all of that is now falling away. So the way we see the market is that we were negatively affected by a ton mile reduction by crude oil tankers taking refined oil products. Lots of traders and oil companies have told us that this is not a repeated pattern because contamination issues, voyages that require too many discharge ports has meant that this didn't turn out to be a great play for most of the people that took that chance. So our expectation is now that you're going to get the 6%, so to speak, back in the end of fourth quarter, first quarter. So for us, it was just a strengthening negative effect of a seasonality that has kind of made the gap wider than we've normally seen. Otherwise, for us, there's nothing extraordinary, and we're quite convinced that we are now on the way back to an upturn as we would normally see it here by the end of Q4.
Okay, thank you. And Lois, is this something that you see going on as well, especially with the crude tankers? And what's sort of the status at the moment, would you say? Have those tankers returned home, or are they still messing around on your turf?
Yeah, I would dovetail on the comments there. We're seeing them extricate and move back, to their own sectors. So, that's a positive of lifting kind of, off the clean markets. At Seaways, we're strong on the MRs. Our LR1s actually trade dirty pretty consistently. So, speaking specifically to our book, on the MRs, and you've still seen very healthy markets. It's Q4, book to date, as we had shared when we did our recent results, you're still in the 20s, you're over 20 a day, and that, and seeing the MRs really get a little busier here after Thanksgiving.
It is what we tend to say, isn't it? That Thanksgiving is sort of the kickoff for things on the product side. What about you, Robert? Do you see the same things? Has there been any change in sort of the inefficiencies that were leading up to the summer? I mean, post the invasion of Ukraine, or is that not a factor really?
No, that's not. I don't think the inefficiency. I don't think that has changed. I think that one thing I would add to Lois and Mikael, we saw a lot of, let's say, refinery maintenance brought forward. A lot of the big Middle East refineries were being shut. They're now starting to come back up, and I think they're pretty well all up now. That sort of finished around about November 30th, and that resulted in a instant movement in LR2 requirement. So you're seeing a very strong firming in the Arabian Gulf, already. Yesterday we had something that we haven't seen for a few weeks, which was there were 7 LR2, what you would call stranded cargoes that owners were not willing to offer to near the rates, that you're starting to see the potential for, just spikes. So, AG West was beginning of the week being worked at, 3.4. And, the desks are sitting there looking at, they're going to get 4 very shortly. So I think that played into a factor about the refinery position. I think a lot of that was to do bringing it forward. There wasn't the pressure, in pricing. We've had a very, very warm winter, in the warm start to autumn in the northern hemisphere. So, it's good, but it's very hard to talk about weakness. I mean, I think that, everybody on this call would consider that what's happening now is pretty good, and it's pretty good to extremely good, especially when you see something that none of us have ever had in our careers, which is very deleveraged balance sheets. So what is 30,000 this year in a market is the equivalent to, almost 40,000 last year. So if you were to model this on your actual cash flow return, as opposed to, just straight market data points, you would feel happy.
Yeah, the cash break evens definitely improved, so that is a factor. And then Carlos,
I wanted to add to that on this point, which I agree with what was said just now by the panelists, but wanted to emphasize further that these lower exports that we have seen over the last 2 months, and there was quite a pronounced decrease in exports out of the Middle East. Those were the ones which were actually driving the market in the first half of the year, which were making the market exceptionally strong, because they are very rich in ton miles, and they are long voyages in any case, but they were particularly long voyages because of the fact that the vessels are sailing through Cape of Good Hope rather than passing through Suez. So this decrease in exports had a major impact on the market, and I think that when they come back, and they will come back, and we're already seeing, as Robert referred to, an improvement in activity in the Middle East, and more will come in the course of December and in January and February next year, then I think the market can turn quite dramatically, much stronger than where we are right now.
If I can follow up on that then, as well.
One last point is that over the course of the year, first semester, but also through the summer, there was a buildup in stocks, in particular gas oil, in the ARA region, and which is also connected to the weakness in industrial activity in Europe, in particular in Germany. We see that gas oil demand this year worldwide actually decreased, It's expected to decrease by around 260,000 barrels per day. And so this increase in stocks is dampening demand for further imports into Europe. And it's also explaining some of the weakness now. But of course, these stocks will be digested. Other regions have very low stocks. And as they are digested, demand will return, and we will go back to the dynamics we experienced in the first half of the year. I'm quite convinced about that.
Yeah, that was to my question, because I was going to ask a bit on the fundamental demand here, because there's been quite a lot of talk on weakness. Mostly, I feel focused on China, perhaps, but I guess Europe is also a factor. I don't know if anyone on the panel wants to add to that, and sort of, is that something to fear, or is it purely weather related, or what's been driving this, especially the refinery margins, which I guess have been pressured downward? I don't know if you have any good takes on that. Lois unmuted, so
I'll jump in and simply say it's very interesting because, you know, products in a way is a secondary market, right? And, you know, as you see some of these refineries, their margins get squeezed. You know, we have an excess of refinery capacity in the world. We've been bringing on a lot in recent years, particularly in the Middle East. Then subsequently also, or simultaneously in China, you've got your West African Dangote that came on. Interestingly, West Africa is still importing 1 million barrels a day of products or thereabout. And so it's really quite, you're seeing Dangote export and import, which of course we on the product side love. But, you know, as Europe, more simple refineries get squeezed, you know, as long as, and we're not seeing, we're seeing pretty steady product demand in Europe. So if those, you know, as some of those refineries close, which is projected for 2025, you need the imports, right? So, you know, on the product side, you know, yes, refinery margins being squeezed is not super, because we want them blowing and going, right? That pulls barrels, super. Still, you know, when you get pressure and then the older, less efficient refineries, you know, suffer and close and maybe retool over time, you need to bring in those products, and that's what we're there for.
Okay, thank you then. And then a bit more focused on what's been going on. And Robert, you mentioned it a bit. The latest fixtures look to be improving, so things are starting to happen. We had you at on a roadshow with a few investors as well, Mikael. And I think they all came out of that rather bullish and said you were the same. So what have you been seeing recently, and what makes you optimistic for the near-term prospects?
Yeah, so no, that was also our feeling, right? That we were kind of being put a bit into the optimistic box versus many others, right? But I think to be honest, one of the reasons is we try to look a little bit beyond sentiment alone, right? I don't think it's, you know, it's not my function to focus too much on all of these short-term issues. I mean, we look at seasonality and we look at, as you say, fundamental demand and supply. What we've seen over the last 2 weeks is that, as Lois alluded to, it is true that, and Carlos as well, that we lost ton-mile for the reason we talked about. Lots of our ships have been doing shorter voyages, so you haven't gotten them out of the area. So like you load discharge and you're quickly back again. What we've seen the last 2 weeks is that the arbitrage is widening very quickly for freights from east to west. So we see that the arbitrage and the, if you like, the allowance for payment of freight is going up dramatically as we speak, indicating that the trend towards the winter, which is for us is dominated by 2 things: more cargo loadings, more cargo, more products on board ships. We look at our measurement for the last few weeks, it's pretty clear now that loadings are increasing on ships, which normally will lead to further ton-mile. So we think we're in the beginning of seeing a market rebound for the reasons that there's more cargo flow, there's better arbitrage, there's higher freight rates now being able to be paid for east-west voyages. And that is exactly what we want. That is what we've been lacking, is the longer voyages, as explained before, of middle distillates. So, you know, we're certainly seeing, you know, the first signs of all these things pointing in the right direction.
How do you, Jorgen, very quickly, you know, how do you disbelieve someone who's sitting with a beautiful rosy lighting background and almost looks with his white hair as if he has a halo on his head, right? I mean, what can I add to that in terms of credibility? But look, I agree with Michael, and you've got some little signs now. You know that your desks, your major desks now, for example, on the MRs in the Gulf, are trying to stay short because they're very confident now that the market will move up and the long, rather than fix away long in a short market, that you're starting to have big rate volatility. I mean, you had one void in the handies that was $35,000 a day 8 days ago, fell to 35.15 and 5 days ago, and now is back at 35. So whenever you see volatility start coming into a market, you know that you're close to a breakout. From where, if it's in a weak market, it's a breakout to the upside, and a strong market, a breakdown. And then you're seeing that point that others have made, that east to west leg on the LRs twos will pull so much away and get things moving that the others can just fall into that gap. And then nature will do the rest, as it always does this time of year.
Is the explanation for the pickup post Thanksgiving, is that really just winter in the northern hemisphere, or what's the background behind that?
There's the whole host of things. Some people don't like to have, you start then to have longer voyages will deliver products crossing the year. So some people will wait because they don't want to have products for inventory or tax reasons, or use of capital reasons in the traders. So it's always a very unusual time. And this year it's been compounded, I think, through the election, where there was Biden was trying to do what he could to keep oil prices, product prices down. There's uncertainty in the market, who's going to win, what will happen. So there was a risk off in all markets going into the election. And just simply, and then this refinery issue with the Arabian Gulf refiners coming, doing their maintenance early.
Okay. The reason I'm asking is because a lot of people have expected seasonality in tankers this year, and people are a bit tired of seeing it not pick up. So there's still hope for the product side, I guess.
No. But honestly, they must be very young, right, or very new to shipping, or both. Okay, because it really is, the normal distribution is 1 week before, 1 week after, and it's definitely picking up. And as all of us are, if you look behind the curtain, if the companies here, if we were sitting in a bar, we'd be going, oh my God, what is the nonsense? This is not a weak market. We're making loads of money, and what a great rate. The rates that Lois is talking about in her MRs is a fantastic base. You have to turn the glass over. It is incredible, with all that's been thrown at the market, that the market is still this strong. The VLCC change with the crude, the refineries coming early, the waiting for the traders. I mean, wow, it should be lower than this. We're much lower. This is this is great. So as soon as that demand happens and you clear, the rates are going to spring upward.
Okay, good. And then Carlos, let's turn a bit to the presidency, if we can, in the US, where you have Trump inbound and probably stricter sanctions on Iran, maybe a resolution at some point in Russia. A lot of geopolitical events have really driven up the tanker markets, I think it's fair to say. But how do you feel we stand, and what do you expect when we get to January next year?
Yeah, on this particular issue that you refer to, Iran, when Trump was last president, the enforcement of sanctions against the country was very strict, and the country exported very little oil, around 0.3 million barrels per day at the end of his presidency. And what we have seen is a gradual ramp up in exports over the last few years. This year, it has reached around 1.7 million barrels per day, from, I believe, 1.3 last year in terms of exports. So there's a lot of room for these exports to be curtailed in the future through stricter enforcement of the sanctions, which would mean that the lost barrels from Iran would have to be compensated from with greater exports from other countries, which would be transported on compliant vessels. So it would be very positive for tankers in general, possibly more for the crude tankers, but indirectly also for us, for the product tankers. So in that respect, I think that the Trump presidency could be very good. But in any case, what we are seeing is, apart from Trump, on the sanctions issue, a much stricter enforcement by other countries too. Recently, we have seen the UK and the EU, but also the US already prior to Trump, targeting more specifically vessels, sanctioning them and making it very hard for them to continue trading. So when you look at the shadow fleet today, which it's possibly around 670 vessels which are engaged regularly on such trades, you already have over 1/4 which are explicitly sanctioned and growing very fast over the last few weeks. So it's probably actually much more than 1/4 by now. And if this trend continues, this also could be very positive for the tanker sector generally.
Can I ask, do the Chinese care, or are they cautious to import this type of illicit oil in any way? Is that something that's changing, or will this be allowed to continue even though they're sanctioned? Let's say they go in a very particular trade, right, out of Iran or Russia and towards India or China, which has been going on for a while. Is that something that you believe will change now that the actual sanctions are in place, and we perhaps see more will to enforce this from the West? Or does that help in regards to Trump coming in? I'll leave that open to the floor. I don't know if anyone. It's a really important subject, I think. So whatever you see and feel and hear, I think is of great importance.
I was wondering whether that was going to be a title of a song. You know, do the Chinese care? A little bit like, you know, the wonderful Sting song about, you know, the Russians love their children too. So they haven't cared historically. But as was pointed out, that, you know, that didn't stop the fact that they didn't care in the previous Trump administration. It didn't stop the position that Iran was really cut back from its exports. But to expand that further, you know, Trump could be, you know, interestingly very positive. So let's say you have peace in Ukraine, Russia. It's then in Trump's interests to not just try and get the political gain in the US for making, you know, a peace and stop the US spending lots of money, but also he's going to benefit from the economic position where I don't think Europe is going to turn around to Russia and immediately say, oh yeah, everything's forgiven, you know, and Germany start taking in gas again like no tomorrow. The more likely thing is that Trump is going to sit down and say, guys, look, you still need my protection. Now, you know, you are going to take in my gas and my oil. So I see whether, you know, whatever it is, I see carbon energy moving from the US or the Americas towards Europe. So that's one positive for Trump. The second thing is that, you know, Iran tried to kill the guy. And a Democratic, you know, FBI, CIA has confirmed that that's what they were trying to do. So I don't think the I think he's going to go for it big time in Iran.
Yeah.
Then you have the point to, then you have Israel. Netanyahu's, top of the chart since he started to become aggressive in the situation. Why on earth would he leave Iran where it is to carry on building their nuclear position? Now, I'm not saying it would happen, but the chances are certainly increased that, real pressure in form, military pressure is brought on Iran.
I mean, Robert, if you build off of what you're saying, even the current Biden administration, we're seeing it coming out every day, right? So now 35 entities over the last, maybe, week have been additionally sanctioned, right? So you're seeing specific vessels and, so all of a sudden, even the Biden administration is ratcheting this up. And, all of us being at the tanker parties in Dubai and in Riyadh in the last few weeks, a lot of positive sentiment in Saudi on Trump coming into play because as the pressure ratchets up, then more Saudi barrels can come out.
Yeah.
On proper tonnage.
Yeah, I think that's it's a fair point. I think because you have several parts of that geopolitical situation which could impact tankers, right? The first one, as was mentioned, I think is a lot down to the crude tankers, right? Which and I can ask you that, Lois, but I guess it would be an affirmative, but it's clearly very important that you get the missing piece in place in the tanker spectrum, which has been the VLCC side, right? VLCCs have been weak, which is spread across the entire sector, I would argue.
Well, and if you bring it back, you do connect, bring the Afra piece back. Those weren't all V's that were sanctioned. There's a bunch of Aframaxes on there because the Aframaxes are choice ship come out of the Baltic, right? So, that dovetails with the LR2s and, all these guys on here, on the call, that have their LR2s, if you take out some of those Aframaxes that are quite aged, that's an old fleet, right? That only creates some positives on the LR2 side.
But then you have I guess the aim of sanctioning Iran tougher than has been the case up until now would also be getting an end to some of the unrest in the Middle East, right? So the next step to that question would be, okay, what happens if the Red Sea reopens, which could be, the end game here. I don't know if would Mikael like to take a stab on that one? How much of an impact would that be to the tankers, the product tankers?
Yeah, so I mean, so obviously, if there is an end to the Red Sea crisis, and let's just remember, there's a long way from kind of ending and having peace negotiations to actually having a safe passage, right? So even with what's going on now and debates going on, I still think we are far away from us feeling comfortable sending ships and our colleagues up through the Red Sea. But if we look at where we were before the Red Sea crisis, and we looked at the earnings and the ton mile increase, we were probably looking at something like a 20% difference in freight earnings from where we were before. The market was pretty high before the Red Sea crisis started. I mean, we were doing close to $30,000 at the time on MRs, and probably went to like 36. Just take some average numbers. So for sure, yes, if you remove ton mile, that's always going to have an effect on the market in a negative direction. But we're not talking about a collapse because we were already having a pretty strong fundamental market. I think when you talk about all these geopolitical issues, including Ukraine, Russia as well, of course, things will get solved, right? We all know that. But the interesting part for us is that, Russia-Ukraine situation, if you live in Europe, I think it's pretty evident that you will never go back to where you were. So we're not going to see a situation where you're going to have like short-term barrels from Russia into Europe, replacing the trading patterns we're seeing today. Nobody believes that. Even in a time of peace, Europe will not go back to be depending on Russian oil the way it was before. So we don't think that, you're going to be losing from that geopolitical crisis a lot of ton mile. But fundamentally, the interesting part here is, as Carlos said, there are 700 ships roughly in the tankers that are part of that dark gray fleet, right? And in a situation where things kind of fall back, those ships are going to disappear. And even with the current order book we have today, I have to say that everything falls away. The reality is we have a lot of ships that will have to go and get scrapped. And we've seen the quality close eye up in Hafnia on some of that fleet, right? And I can say it's these are not ships that are being maintained. These are not ships that people are spending money on. I mean, these are ships that will have a very limited chance of trading in any form of normal global trade going forward.
I agree. The average age is just skyrocketed as well. So I guess that says it all. I agree with you, Michael, but let's say I want to disagree and say why would not the product flows return to normality, you can say, post that situation in Ukraine? Let's say everything's resolved, right, and people sign a peace treaty or whatever, and then it's a bit tough from Europe then saying that they disagree with the peace treaty, because that would be hard to get things over the finish line. They're not in. I would argue that you've proven now that you're not dependent on Russian energy, because you've now shown the flexibility in the shipping fleet, right? So why would you be afraid to take the cheapest available energy for a while when you've shown that you are pretty robust in terms of sourcing?
Yeah, I mean, I can just have one quick response on it, let the others come in as well. But obviously, that's what's going to happen as well. So obviously, there'll be a mix of it. What I said is Europe is not going to be depending as we were before. We have to remember the distance here, right? I mean, if you're depending on short-term distance of transportation and that goes wrong, there's a pretty long way for replacing that. And the energy crisis we saw in Europe on the gas side was exactly part of it, right? So sure, there'll be a mix of it. I think my view was more that you're not going to roll back to where we were, which was to a big extent a very big dependency on Russian oil moving from the Baltic into Europe. So sure, there'll be a mix of it. That I do agree to.
Fair point. The others.
But I also, I think just very quickly, I would add to the point that, I agree that you'll still have some trade, but the difficulty is the actual ships. So you're not going to go Russia to the UK for BP with a old ship. You sure as hell aren't going to go with an old ship that hasn't got all its certificates, etc. So
yeah,
it's going to get,
finally,
if I might, it's going to get super interesting because, we always live and learn. One place where Trump was not wrong is, because, we sat down with a NATO, one of the top generals there. And, it was true that there was like single digits of the NATO countries actually putting up their GDP and preparing themselves, right? And you can bet that even though now, probably because he made a large kerfluffle the first time he was in, there are now the majority of the countries are contributing their GDP and cranking their forces up. And this is all going to evolve, but that really focuses yourself, right? When, you have to take your country and devote more of your resources to your defense, it sort of focuses the mindset, and all of that dovetails through, so, if you're going to have to do that, and then you're going to, are you going to be, it doesn't look like there's going to be a clear winner, not that there's ever any winner when you have this kind of mass casualties, but, this is going to take time to play out and be very messy.
Okay, good. And then on the final part with Trump and tariffs and whatnot, I got a question from an investor actually on the implications for product tankers from a stricter tariff regime against Canada and Mexico. Is that something that you've given any thought to? Whoever wants to answer, what are the implications for product tankers in that from that type of a scenario?
I would say, if these tariffs are implemented, and I believe it's more of a negotiating tactic, which he has used often in the past, and he might implement them gradually. If so, he might try to obtain other concessions from these countries rather than implement such tariffs. But it is not a given that oil will be included in the tariffs. There might be an exclusion for oil. for obvious reasons. I mean, I think that one of the biggest concerns and probably one of the reasons why main reasons why Trump was elected was the effects of inflation in the US economy. And of course, a big tariffs on Canadian oil, of which the US, I believe, imports around $4 million per day.
4 million. Yep.
4 million.
80% of Canada's oil. Yep.
Yeah, would have a serious economic repercussions, right? So, but if it were implemented, I mean, at least some of that oil would, find another home possibly, and instead of being transported through pipelines to the US, would be transported through ships to more distant locations, right? So if you're putting tariffs, especially on close trading partners, you create inefficiencies, and shipping loves inefficiencies. So, and then the US would have to replace this oil from Canada through imports from other more distant locations. So in that sense, I think it could be positive for the tanker sector.
Okay.
I think that we would clearly have higher in the US here. We would have much higher expense reports from our chartering departments if there was a tariff put on Scotch whiskey, wine, etc. We'd have an increase in G&A across the board.
Okay, I hope we avoid that then. Okay, if we move a bit to the supply side, it has been mentioned the order book and the supply story for tankers has been one for some time. There is quite a lot of interest ordering the mid-sized tankers and product tankers at the moment, which is still sort of ongoing. Next year, we have 6% gross deliveries, then you have 7% gross deliveries in 26 if you look purely on the product tanker space. Is that something for the investors to fear, Robert, or do you see it differently? Is it the end of the supply story for tanker shipping?
No, I don't think so. I mean, you're only giving, I still have the actual total number over, the full delivery period of ships on order, less than the ships that are going to get aged out. So you still have, a strong supply side from, the older age of the actual fleet itself. If we again look historically, I mean, 13% in 2 years is not something that I would say to be afraid about. If we go into 2006, 2007, 2 super strong years, both those years probably had over 13% in just those years of deliveries. So, supply is not really the thing that has ever to be feared about. The markets have always, crashed because of demand. So it's demand that breaks down, and then it's this order book that, if it's very long, without scrapping, is the one that kind of slams the door and puts the industry into distress for quite a while. But I also think it depends on your expectations. I mean, we've had all of our stocks go ballistic for 2.5, 3 years, super strong market. So almost a one-way direction on rates. And things have changed. What people should look at now is the quality of the balance sheets of the companies. The fact that the order book is not frightening, it's not low, but it's measured relative to what's going out. That I don't think any of us would sit there and, if we were having a drink, and expect our stocks to quadruple over the next 18 months. But the risk to the downside is much lower than it's kind of ever been in our companies, because of the strength of the balance sheets and the order book that is so aged now that you have to do a release. And the chances of strong cash flows relative to stock prices is very high. I just think we have to do a reset at the moment from the expectations. I mean, a lot of mistakes were happening. I mean, all of us gave our earnings guidance in July. And many of the the analysts just took our earnings estimates and extrapolated them for the whole of the third quarter, even though on the conference calls we were saying we expect to have seasonality, and the market is already, and they could look at the indexes and know that the recent fixtures were lower than the fixtures in June. And it took until I think the third week of September before analysts started to downgrade the companies, and the investment community was kind of oblivious to all of this, until the shock came. Oh my god, the tanker market's gone down, this is terrible.
It seems like you're getting hit 3 times, right, on every bad news, which is a bit strange, right?
Exactly.
You get the rates, which make you selling off, and then you get the estimates coming down, which you sell off on, and then finally you deliver the results everyone's expecting. But that's too bad, I guess.
Of course it is, but
strange situation.
But the great thing is that none of the companies have to raise equity. In fact, they're doing the reverse.
Yeah,
and you're right in front of a strong season, and the balance sheets are great. I mean, if you looked at the forward curve by the time charters, even though whatever, these companies are throwing off masses of profits. If you just plugged in what the rates are today, you would have tremendous cash flows going forward next year relative to the present stock prices.
Yeah. But you hear you're building expectations now, Robert. So
be
cautious.
No, I don't need to be cautious.
You have to have some expectations in life.
Yeah, of course.
I think you have to. I think you have to go with what you think. I don't think it's a question of I'm not saying I'm not saying. I'm saying people need to have a reset. It's like stop being disappointed that that all the stocks have fallen from their highs.
Yeah, right? That just screens like an opportunity to us. So, but then again, you touched a bit on the buybacks, which I think is interesting. So asset values for MRs and such have come off a bit, but there's more downside priced into the stocks, right? And buybacks are sort of the norm, I guess, a bit when you look at how the equities are trading. Where do you think asset values are headed? I mean, if I look among the peer group, you're sort of pricing in almost $30 million for a 5-year-old MR. Today, it's at 45. It's rather an extreme drop, right? And since I have you on the main scene, Robert, and see you, then you've had buybacks. You've been trading at a discount, which implies sort of low 30s maybe valuation for an MR. Where do you think asset values are headed a year ahead?
I think the calculation. I think that you haven't seen many transactions. It's not like there's many willing sellers, willing buyers at where the point is right now. Because why would anybody, if they sell at low prices, right in the face of the stronger season, and their balance sheets are strong? So you're not seeing, one of the things you're not seeing at the moment is a group of desperate sellers. In fact, you have a whole bunch of companies and private owners out there who've made fortunes, and you have charterers who are going, hope it comes off. I may be able to, buy a couple. But I don't think you have to, we're not making any determination of where we think the prices will go to. We're just making the determination that it's just so overdone in the long term related to stock prices of companies, and we don't see it falling. I mean, we know we're making cash flow, so the stock is actually creating a much lower boundary than that. Because if you think it's showing $30 million for an MR, it's really showing lower, because remember, all of our companies are making cash flow right now.
Right.
Fair point. And what about you, Michael? You last quarter you also announced the buybacks, right? I guess in support of the valuation of the equity. What are your thoughts on that?
Yes, exactly. So again, I mean, that steep discount obviously made it super attractive for us to start a share buyback, which kind of comes on in addition to the dividend that we've been paying out for Q3. But I think it's right what Robert is saying. So I mean, on the asset side, there's probably two discussions. One is the new builds. So there's no doubt that the people that wanted to order new builds at these very high prices have done that. You're so far out that we're now seeing the interest for new builds on the tankers is not that great, and those prices are definitely coming off a little bit as we speak. But that's a function of something different, right? That's not just the current spot market. It's also the fact that most people interested have already done what they want to do on the new build side. I think on the second-hand assets, as you said, as Robert said, there is a weakness because a lot of it is close to a spot market and short-term time charters, 3 years time charters, how you can match buying with chartering out. And at the moment, there's no real connection between second-hand assets and what you can charter ships out right now. So that kind of kills the project way of buying an asset and guaranteeing earning for 3 years. But, sellers are not willing to go down and take these levels. So, I think the very old ships have been very much driven by the dark fleet that seems to be saturated now. So, I think we're just in this normal position that is a bit of a standstill, very few data points. And in a rising spot market, you're going to see rising time charter rate. And in my view, that's what's going to trigger asset values again, is that 3 years time charter rate starts moving up. And once they do that, you're going to see people start buying secondhand assets, put them out and protect their returns for that period.
There seems to be a disconnect, right? Because it is a fact that when you look at the overall contracting and shipping these days, tankers has really taken over, right? So that's the one go-to sector, it seems, where people are actually willing to put money on the table at these prices we're discussing, which would imply still high secondhand values. Yeah, give it a go if you want to how they're thinking.
No, it was just to add on to
pass it around.
Yeah, it was just too quickly to say, so what you mentioned before. I mean, I think fundamentally, when you look at our markets going forward, right? I mean, it is true that the order book is probably higher than what we expected, because basically prices have been so high that it's like, wow, it's kind of massive levels to go in at. But if you look at a 5-year period, I mean, so the 20% order book, first of all, it's probably not 20% product tankers, because half of it is LR2 ships. And traditionally, LR2 ships, 60% of LR2 coated tankers end up trading as Aframaxes. So in theory, it's just the coding just puts them on the product tanker order book. In reality, these are Aframaxes that will trade crude. So if you net that off, it's probably more like a 13%. But the reality is, we're going to be losing so many ships the next 5 years that the risk is probably what comes first, right? So do we see a lot of new builds coming in before scrapping starts? Then you may get that overlap for a short period of time where markets are going to be slightly oversupplied. But that's probably the ratio. But over a 5-year period, we're going to be massively short ships. I mean, over a 7-year period, we're going to be massively short ships because oil demand is not falling. And at the moment, we're carrying half the fleet that will need to be scrapped within, the next 5 or 6 years. That's the real, I mean, that's why we fundamentally are positive, all of us, is that we're not measuring our market in the 6 month horizon. We look out there 5, 6 years and can see that this supply demand balance is massively in favor of the owners.
It's quite. I mean, if like to the extent that I think is, if you look at Mikael's company, right? It's easier for me to talk about Mikael's company than mine. But I actually sort of had a good laugh at Mikael on, the day after his earnings, right? To his face, it's like, wow, Mikael, I bet you must feel great that you just give the shareholders back 7% of your market cap in a dividend in what they're calling a shitty quarter that's really bad, terrible, and I need to take the antidepressants, and then you add $100 million buyback to it, and the stock trades down to start with.
Yeah, well, to be fair, I think the
there's
another main tanker company that reported the same day is not here to defend itself, but it was a relative outperformance of almost 12%, I think, on the day. So hats off to Mikael and Hafnia on how they managed to communicate things, I think. And I wanted to hear with Carlos as well, because it is a fair point. You know, the new building prices are relatively sticky and high, and then you talk about scrapping, right? Which imply that, you know, asset values perhaps need to come down. How do we sort of reconcile that when we look at the NAVs, right? I think that's an interesting perspective. What will sort of, when will scrapping happen and why will that happen? Barring sort of the gray fleet, right? Which is,
I mean,
situational.
Yeah. No, well, on the scrapping front, if it doesn't happen before, and you know, if it doesn't happen before, it's because we are in very strong markets because the fleet is aging rapidly. But eventually, you know, we are reaching a point where we are getting close to 25 years of age for the vessels that were ordered in the last super cycle. So we have a potential wall of demolition candidates, which is going to hit us from 2028. I mean, from 2028 to 2031, each year, around 5% of the product tanker fleet will be turning 25. And then thereafter, these percentages actually increase and they peak at around 8.4% in 2034. So there are really a lot of vessels that are going to have to be demolished, irrespective of how the markets are doing from 2028, because it's going to be very complicated for them to continue operating. And I think this is another point which was made in previous conferences, which I think is also valid, is that as these vessels cross the 20-year threshold, then they become less productive. They are very limited in what they can do and the trades in which they can operate. As long as, of course, we have these sanctioned trades, they find a home. But if these sanctioned trades were to diminish, then this would be a very overcrowded market. Too many vessels over 20 years of age for the employment opportunities available. So they might be scrapped even before 25. So it's so I think that, you know, we have to look at this when we analyze how big the order book is, and I think that it's definitely not as big as one might fear because of the rapidly aging fleet profile.
Okay, I see we're running a bit over time, but we have so much to discuss. I think I have a question here that I want to end the webcast with, and it pertains to the capital allocation strategy among
Well, and I
your
thought
companies.
you were gonna forget, Jorgen.
We've been touching on it, but I guess, you know, we talked about equities trading below values and considerably below values. I guess buybacks becoming even more interesting. But just very quickly to reconfirm what I might what I'm sort of expecting, but where is the preference among buybacks, investments, and dividends these days, and why? Just very shortly. We can start with Lois, maybe.
Okay. So, you know, we've been, you know, we have a small regular dividend, and then we have our supplemental dividend, right? And so we've been more dividend oriented, but we also have renewed our buyback and have done some buybacks. So we've hit on every cylinder. You know, what I like to focus on is every dollar free cash flow has either been reinvested in renewing the fleet and getting the fleet younger, you know, or paying down debt, and in dividends or buybacks. So we've been balanced.
Robert?
We're very unbalanced.
Fair enough.
In personality as well. So I think, look, we've been fairly clear. We're keeping a regular dividend. You know, it's been low. There's really no reason to raise that at this point in the market. We've been taking down our debt. You know, our debt's reached a great level that we're happy with, but at the same time, we're doing endeavors that will further, you know, strengthen the balance sheet and the flexibility of the balance sheet. I think you know, history has proven that there's great opportunity, but when you approach markets like this, where there's a lot of volatility, investor uncertainty, etc., your best position is to always play from a incredible liquidity position.
Don't you think the share price would improve though if you upped your dividend? Or why would you?
Oh,
that,
it's just so fun. This is so fun because I actually had a Norwegian ring analyst, not yourself, ring me up because they know that we're shareholders of Hafnia on the private side, and we added to that on their earnings. And this guy rang me up and he started moaning. He said, "Robert, how do you feel about Hafnia? Mikael, why don't you give him a ring? Why on earth is he spending $100 million on buyback? Why didn't he just increase his dividend?" I mean,
he did that as well, though. So it was,
but the whole lot. They consider that wasting his $100 million because they could have done that in a dividend. I mean, look, dividend. These, it's we don't like them. We simply don't like them. History, that's our view. History has proven that there is a payment.
The market seems to like them these days, though. So it's a strange situation.
What was that company that report? What was that company that was down 12% on their reporting?
let's not mention people not here, Robert.
Are they a high? You mention them, not me. Are they a high dividend paying company? Yes or no?
They tend to be. Mikael, what about you? Quickly, we're running out of time.
Yeah, exactly. No, so basically our capital allocation has been focused on and tied up to the net loan to value, right? And so we broke 20% in the third quarter, and that means we're paying out 90%. So traditionally it's been paid out dividend, but as you saw this time, if we see a big disconnect between share price and NAV, obviously we will always turn around and debate whether we should buy back shares. But the dividend policy is fixed now at below 20%. We pay out 90%. And that could be both in terms of share buybacks or just actual dividends.
Which is interesting because it's now turning more towards dividends, maybe, or buybacks, maybe. So it's a point to be made. Carlos, lastly, and then we'll end it after you.
Yeah, so no, we also try to maintain a balanced approach. We don't have a dividend policy, but we try to guide a bit investors as to what our expectations are for the current year. Last year, out of our profits, we paid out through dividends and share buybacks around 30% of our profits. This year, the plan is to pay back around 40% through dividends and buybacks, and there'll be more buybacks if the share price is particularly weak, like right now. But we will still try to maintain a balanced approach because our shareholders also want to receive dividends, including the controlling shareholder. So, yeah.
Okay. So to everyone listening, balanced or unbalanced, you can make your pick. And I think at that, we'll end it today. Sorry for running over, but I really appreciate all your insights, and I hope everyone following is a bit wiser now than we were an hour ago. All right. Thank you all.
Thank you.
Thank you, Jorgen. Great job.